I'm joined by Graham Potts today for our discussion about cash in your business. Graham is a chartered accountant and managing director of our accounting firm, Wessex Commercial. With an eye for numbers and years of hands-on business experience, he is great at spotting the changes you can make to increase cash and profits. If you have questions about business finance, pop them in the comments and we'll try to pick them up as we go. Today, I know you want to talk to business owners who think they need to raise finance. But what do you mean when they say they should think again?
Thanks, Debs. When cash is tight or starts to dry up, the natural reaction is they need to borrow money. However, there's lots to consider when actual borrowing, such as the actual additional costs and additional risks. So we recommend you look at alternatives before you commit to any borrowing.
Interesting. So what do you want to talk about today?
Three main topics, thanks, Debs. Understanding why you need finance in the first place and what are the best options. Then understanding what are the additional costs and also the risks to you as a director on taking on any extra finance. And then exploring alternatives that may mean you don't need to borrow more money.
Okay, can you discuss why you need finance?
Yeah. First, what is the money for? Is it for like working capital? Now, working capital is the money you need to run the day-to-day business. So it's spending on stock, materials, wages, transport, less the money that you'll get in from the cash or credit. So that's working capital. It could be investing in new equipment, in property or infrastructure. Could be paying for research and development of new products. It could be covering a downturn in the business or a project, or it may be even covering supply chain delays, etc.
Okay, so let's say it's working capital or a new vehicle.
Okay, so whatever finance you need, you should ideally match the period you need to finance with the finance product. So with working capital, it's likely you're going to need that for quite a long time. So maybe consider a long-term loan, equity shareholding, or maybe even invoice discounting. And that is especially good when you give credit on your sales and sales are variable, or if you're growing fast. With a new vehicle, consider if you want to own the vehicle at the end, as there are a number of ways such as hire purchase, lease purchase, contract hire. And also you have to look at whether you want it in the business, company cars, etc. But that's a different topic. We're not going to cover today. But you can get on contract hire, you can get and leasing, you can get half the VAT back. But sometimes it's not worth to have the company car in the company. It's not cost effective from a tax point of view. But you speak to us if you ever want to know more about that. But you should match the finance to the length of that you're going to have the vehicle for or asset. And then what we also think is that look at how your interest rates and the costs match your future cash position. How can you afford that finance?
That makes sense. So can you explain what you mean by taking on finance comes at a cost and risk, though I think we know that there's interest to pay?
Yes, there is interest to pay. Interest rates and repayment terms will vary on the product you choose and the perceived risk of your failure by the financier. So with the recent turmoil in the markets, with the government, etc., with the in out, shake it all about tax changes, these markets are predicting that the base rates now will rise to probably 6% in 2023. Might come down, we just don't know after Jeremy Hunt's budget or his announcement yesterday. Sorry. Whereas 3 months ago, we were talking about a base rate closer just over 3%. That means the cost of borrowing currently has significantly increased. And whilst the more you're seen as a poor bet, the worse the terms you receive. So for instance, a good risk will be 1 or 2% over base rate, whereas a poor risk could be 20, 30, 40% over above base rate, which would mean the cost and the length of the loan being much higher, with interest often being much more than the initial borrowing. You can think that if you worked out your mortgage repayments, how much you borrow and how much you pay over a period of time. Now, with interest rates going up, that is just going up and up and up. So every extra percent and every extra repayment month that you have is an extra cost for you.
Okay, so is there anything business owners can do to position their business as a good risk or lower risk?
Well, financiers always consider a good risk where they have confidence in the management, where the business is profitable, and where they have good security, like a vehicle or other asset. So up to date management information and accounts and forecasting is key. That gives them confidence you know what you're doing. And if you're loss making, then and you're going into profit, then if you can show by future profits and the reason behind to a financier, that will help you secure probably better terms. So future projections showing how you can afford the repayments is key to help demonstrate that you know how to run the business.
Okay, but what about any other risks for directors?
Well, security is often required, which if the business is seen as risky, hasn't got enough security in property, assets, etc., they will include the requirement for a director's personal guarantee. That means if the business is unable to repay the debt, you as a director will be asked to pay it back, which means that your personal assets, which could mean your home, often being at risk. I would say a word of warning as well. Please be very careful of unlimited guarantees, as they could be in place for years to come. So try and put a cash limit and a timeline on them. For instance, suppliers give guarantees now, ask for guarantees. Now, if you're getting something from Bradford's at 5,000 a month, 30 years time, it could be 50,000 a month, and you could even have sold the business and not even realize. So be very careful and understand what you're getting into with guarantees. So you need to fully understand the interest rate is good for you and whether the security is acceptable and what happens if the business fails to repay that loan.
Now, you mentioned that there were some alternatives to borrowing. What are these?
There's quite a lot. It's basically good housekeeping. Are you getting paid timely and efficiently by your customers? Are you regularly reviewing debtors and age receivables? Are you regularly reviewing credit terms and limits for your customers, especially as we head into recession? So some of your customers may be struggling more, and it's often a sign as the payments your payments are taking longer and longer to get to you. Are you paying suppliers on time rather than necessarily early, or could you get better rates and better credit terms from your suppliers? More discount if you pay earlier. Could you get, shop around and find out that actually you can get a better terms with someone else if you commit to them? Are you making the most of your space? Are you making most of your stock, your equipment, assets? These resources should be earning for you as much as possible. So anything that's not earning for you, look at selling, because that will generate cash. And are you ensuring you're not paying for software or products and other asset services that you no longer need? Because obviously everybody gets you tied up for infinitum, but they don't tell you, like on phone contracts, they don't tell you when actually you've actually paid for the phone. They just keep on at the same rate. Very nice that they are with their customers. And you must make the most of secure repeat business with your customers.
Okay. Perhaps you could give an example of how you've helped a business?
Yes, certainly. We had a business review. The client came to us as they had been turned down for a bank loan. They asked for a 50,000 loan. Unfortunately, they were at that time loss making and cash poor. So after the initial review, it was obvious that they would struggle to raise finance because they had no management information. Their last account showed losses and they had poor security. They could have probably got it, but it would have been at 40-50% rates with guarantees. It just was something that the directors wouldn't entertain. So they engaged us to say, well, what can we do? Can you look at our credit control processes and can you look at our pricing? So this particular client bought materials and then manufactured specialized products to their customers' requirements. So what steps did you recommend they take? Well, firstly, Des, we recommended they stop giving credit to individuals and tighten up on their credit control procedures, including pre-quote checks. because sometimes it could take 2, 3, 4 months for it to go through the whole process from buying materials right through to the sale, and then they were giving 30 days. So we said, look, you can't do this with individuals. But then also with businesses, especially the bigger ones, the bigger contracts, we looked at stage payments, milestone payments, which matched our clients' costs and risks. This included a percentage on order, some on receipt of materials, some on delivery, and some on installation. It was always negotiated with the bigger clients, but you could actually manage it. We helped them increase their pricing as well, as they are far too cheap, especially on the lower value works. Now, we looked at this and we had to do it as they didn't have the full information, but we looked at what they had quoted and how different levels, different volumes and different values. And we found that they were winning most of the work under £5,000. Yet over like 100,000, they weren't winning much. So we looked and changed their pricing around so that actually it helped them get more of the smaller work and actually some of the bigger work as well. And finally, we provided a cash flow and then trained the staff how to get that running on a day-to-day basis so they could plan ahead for peaks and troughs.
Okay, so what difference have those changes made?
Well, within 3 months, cash had improved, meaning that they didn't need to borrow. So they had a real sticky time for 3 months. But with regular pricing reviews and turning away contracts that were too risky, not enough margin, so they learned to say no when they should be saying no, not taking on everything. They went from loss making to being profitable after 6 months.
So what do business owners need to do now?
First of all, I say every time, understand your numbers. You basically have to know your figures, like especially where your break-even position is and your pricing in the marketplace. And it's not just one set of pricing, it's lots of difference for different customers, different markets, different values. Pricing is key, and you can charge something extra to someone else. Like if you're charging the big company as a small company, there could be different levels. So don't just price one way, understand what the market conditions are. Next, you have to have good systems and processes in place with regular reviews, such as credit control, terms and conditions, and updated cash flows. You also need to consider what you have, what costs you have, and how to reduce them, such as making the most of your space, stock, equipment. Like so, it's space. Can you rent something out, sublet something? Stock. Have you got obsolete stock or slow-moving stock? Can you shift it to increase your stock levels for the faster-moving stuff? Equipment and assets. Are you not using them? You might need them on a rainy day, but why do you keep them? They should be earning you money. Your resources should be earning you money. So anything that's not earning, you should consider selling. Then you should look at paying what costs you've got that are on, like repeating direct debits, standing orders, etc., such as software, services that you don't need, as I already mentioned, phones. And then look at ways to avoid unexpected use of overtime and subcontractors. For instance, basically, overtime, subcontracts are going to always cost you more than just the normal day-to-day. So if you can schedule better, you might be able to reduce your overall costs. It's all about, as I keep on saying, it's all about maximizing the use of your resources, therefore making sure they work efficiently for you, whether that's people, premises, stock, cash, systems, and getting control of your business rather than the business controlling you. In such a changing, uncertain and at times very, very lonely world for business owners, you need to have good management information and good support to help to make the right decisions for you and your business.
Absolutely. Thanks, Graham. If this issue has struck a chord with you and you want to have a no obligation chat with Graham on a one-to-one basis, then email chatwithgraham@wessexcommercial.com and we'll set up a meeting for you. Our next LinkedIn Live will take place at 12:30 p.m. on Monday, the 7th of November. We'll be asking, are fixed price contracts good or bad for your business? Thanks for joining today. See you next time.
Thank you. Bye.
Thank you.